Welcome back everybody. This is part 2 of this series on inventory in double entry and bookkeeping. Before this, we have covered part 1 of the series where we have discussed sales and purchases. If you wanna go into detail, can check it out. Link is on I button. And in this video, we are going to understand what inventory actually is, how it's recorded, how adjustment works, how inventory is valued, and which accounting principle applies to it. Plus, I'll share some useful exam tips along the way. Now, here's the thing. I like starting with questions because questioning helps build a solution-oriented mindset, and that's exactly what companies look for. So, let's start with the most basic question. Hello everyone, welcome to this Pro the Journey YouTube channel. I'm Mr. Rai. I help you study professional knowledge in a simple and a practical way. So let's start. What is inventory? Inventory simply means the good, material, or assets a business keeps either to sell, use in production, or for day-to-day operation. Simply sell, production, day-to-day operation. For example, raw material. Raw material like wood used to making furniture. Work in progress or WIP. Product that are still being made, which is still in the process. Now, finished good. Finished good is the completed product ready for sale. And maintenance supply. Things like tools or spare parts used in operations, which comes under cost of goods sold. Now the next question is, how is inventory recorded and adjusted? So let's begin with the acquisition, which simply means purchasing inventory in the first time. When a business buys inventory in cash, it records a journal entry like this: purchase account debit $2,000 to cash at bank account credit $2,000. Simple. This records the inventory at the price paid for it. Now later on, adjustments are needed at the year end, like valuation. Valuation to show the current value of the inventories, since value held by company are in the millions and billions. So adjustment of closing balance for opening balance will let it know going forward. So basically, why we are doing these kind of adjustments? So question is why? Because financial statement needs to be prepared properly, and for that all income and expenses must be adjusted correctly. As we discussed earlier, income and expenses or income and expense accounts do not carry forward into the next year. So, inventory adjustment helps convert part of the expense into asset at the year end. Expense into assets. In valuation accordance ISA 2, inventory. Now let's talk about valuation. in valuation according to IS2. How do we value inventory at the year end? And IS2 says inventory must be valued at the lower of cost or NRV, which is net realizable value, which is cost means the purchase cost or adjusted cost using method like FIFO or ACCA. And the NRV basically means the market value at that point. This follows the prudence concept, which prevent businesses from overstating profit or asset in financial statements. Now, method like FIFO and ACCA belongs more to management accounting. So we are not going to go much detail at here. Market price after cost of sales. So we will cover those in detail later. For now, let's focus on the adjustment entries. Suppose a business has been established where purchase during the year is $500 and at the end of the book remaining $200, and at the end of the book market value is $250 where cost of sale is $20. At the year end, the closing inventory is to inventory or cost account carried $200. Since cost is 200 and NRV is $250 less $20, which is 230, where 200 cost is lower. This moves inventory out of expense and treat it as an asset. Then in the next year, a reverse entry is passed. The question is why? Because the inventory becomes part of operations again. So opening entry would be opening inventory account debit $200 to closing inventory account credit $200. This simply brings forward the balance from the previous year. Now, what we understand this concept? Let's move to the practical example which often comes in exams. And here's a question for you. Have you ever noticed how gross profit is calculated? Let's look at it. Revenue minus cost of sales equal to gross profit. Simple formula. Revenue minus cost of sale equal to gross profit. Now, what makes up the cost of sales? Which is opening inventory plus purchase during the year minus closing inventory. Since closing inventory is no longer treated as an expense, it's carried forward as an asset instead. Now let's solve an example together. First, I want you to focus on this part on the screen, lower of cost and NRV. I'll highlight that first. The remaining part, I want you guys to try yourself and comment below. Then I will calculate gross profit and also prepare a T-shape accounts. Here's the question. Mr. Rai buys and sells washing machine. He has been trading for many years. On 1st Jan 2008, his opening inventory is 15 washing machine costing $8,500. During the year, he purchased 85 machine additional for costing $8,000, and on the 31st December 2009, he still has 27 washing machine left with the cost of $7,500. He sold 60 machines during the year. He sold 16 machines during the year for the sales value of $21,000 per machine. Now calculate the gross profit for the year ended 31st December 2009. So revenue is equal to 60 unit into $21,000 is equal to 1.26 million less cost of sale, which is opening inventory plus purchase minus closing inventory, and that gives us the gross profit, where opening inventory is 50 unit of washing machine into $8,500, which becomes $0.425 million. Purchase during the year is 85 units of machine into $8,000, which becomes $0.68 million. And closing inventory is 27 unit, each unit cost of $9,500, which becomes $0.2565 million. Therefore, the gross profit will be $0.4115 million. However, in the exam, it could be asked as finding one of them provided as a missing value. Now let's make T-shaped accounts, where expense in debit sides like opening inventory and purchase, and income and reduce in expense is in credit side. The difference between called as a balancing figure, which
and
is
practicing
gross
more
profit,
questions from the reference books. And if you have any doubt at all, just drop them in a comment below. You can also explore the ACCA practice platform. And if you want a separate video explaining how to use the practice platform, comment below and I'll make one for you. Our goal here is simple: no unnecessary theory, no boring PPT style teaching, just to increase watch time. We want to make accounting concepts simple, practical, and actually interesting. And if you want more practice video, let me know in the comment and I will see you in the next video. Till then, keep practicing, keep going.